Look, I'm going to be direct with you. What I'm about to share isn't some conspiracy theory or fear-mongering. It's what's actually happening right now in the financial markets, and most people have no idea. While everyone's been focused on their 401ks and savings accounts, something fundamental has shifted in the global monetary system. And the people who understand this shift are quietly moving their wealth into physical metals at a pace we haven't seen in decades. Let me paint you a picture of what's really going on. Gold just crossed levels that most analysts said were impossible. Silver's been climbing at rates that have shocked even the most bullish precious metals investors. But here's what's fascinating. This isn't just retail investors buying coins. This is central banks, sovereign wealth funds, and institutional players accumulating physical metal like their lives depend on it. And maybe they do. You know what's interesting? When you look at the data, central banks have been net buyers of gold for over a decade now. But the pace has accelerated dramatically. We're talking about hundreds of tons being purchased every quarter. China, Russia, India, Turkey. These aren't small players. These are major economies with sophisticated financial systems, and they're all doing the same thing. They're converting their dollar reserves into physical gold. Why would they do that if the dollar was as strong and stable as we're told? Here's where it gets really interesting. The dollar's purchasing power has been eroding steadily, but most people don't feel it day to day because it happens gradually. It's like watching ice melt. You don't see it happening in real time, but one day you look down and realize half of it's gone. Your grocery bill that used to be $100 is now $150. Your rent that was manageable is now eating half your paycheck. Your savings account that felt substantial 5 years ago doesn't buy what it used to. This is the invisible tax of currency debasement, and it's accelerating. But let's talk about what's different now compared to previous decades. We're seeing something that hasn't happened since the early 70s, a fundamental questioning of the dollar's role as the world's reserve currency. Countries are setting up bilateral trade agreements that bypass the dollar entirely. The BRICS nations are developing alternative payment systems. Major oil producers are accepting payment in currencies other than dollars. This is seismic. The entire post-World War II financial architecture was built on dollar dominance, and that foundation is cracking. Now, I want you to understand something crucial about how money works. The dollar isn't backed by gold anymore. It hasn't been since 1971. It's backed by faith. Faith in the U.S. government's ability to manage its finances, faith in the stability of American institutions, faith that the dollar will hold its value. But what happens when that faith starts to erode? What happens when countries that have been holding trillions in dollar-denominated assets start to question whether those assets will maintain their purchasing power? This is where metals come in and why they're fundamentally different from paper currency. Gold and silver have been money for thousands of years. Not because governments decreed it, but because they have properties that make them ideal stores of value. They're scarce, they're durable, they're divisible, they're recognizable. You can't print more gold. You can't create silver out of thin air. Every ounce that exists had to be mined from the earth at considerable cost and effort. This scarcity is what gives metals their enduring value. Let me tell you about something that happened in the 70s that most people have forgotten. In 1971, President Nixon closed the gold window, ending the dollar's convertibility to gold. At the time, gold was $35 an ounce. By 1980, it had reached over $800. That's not a typo. Gold increased more than 20-fold in less than a decade. Why? Because people lost faith in the purchasing power of paper currency. They watched inflation ravage their savings and they moved into hard assets. The people who made that move early preserved their wealth. The people who stayed in cash watched their purchasing power evaporate. Now, I'm not saying we're going to see that exact scenario play out again. History doesn't repeat, but it often rhymes. What I am saying is that we're seeing similar conditions: massive government debt, central banks printing money at unprecedented rates, geopolitical instability, and a loss of confidence in traditional financial systems. These are the exact conditions that have historically driven people into precious metals. Here's something most people don't realize about the metals market. The price you see quoted, whether it's gold at $3,000 or silver at $30, that's largely determined by paper trading. Futures contracts, ETFs, derivatives. The actual physical market is much smaller and much tighter. There's a massive disconnect between the paper market and the physical market, and when that disconnect becomes too large, when too many people try to convert their paper claims into physical metal, that's when you see explosive price moves. Think about it this way. If you own shares in a gold ETF, You own a claim on gold, but you don't own the actual metal. It's sitting in a vault somewhere, and you're trusting that when you want to redeem your shares, the gold will be there. But what if everyone tries to redeem at once? What if there's a run on physical metal? The ETF might have to suspend redemptions. You might get cash instead of metal. And if you're getting cash at a time when everyone's trying to get out of cash and into hard assets, well, you can see the problem. This is why physical ownership matters. When you hold a gold coin or a silver bar in your hand, you own it outright. No counterparty risk. No reliance on financial institutions. No trust required in the system. It's yours. And in times of financial stress, that distinction becomes critically important. Let me share something with you that might change how you think about savings. For most of human history, saving meant accumulating real things: land, livestock, precious metals. The idea of saving paper currency is actually relatively new, and it only works when that currency maintains its purchasing power. But we're in an era where central banks are explicitly trying to create inflation. They've said it openly. They target 2% inflation annually. That means they're deliberately trying to make your savings worth less every year. It's a feature, not a bug. So when you save in dollars, you're fighting against a system that's designed to erode your purchasing power. You're running on a treadmill that's slowly speeding up. You have to earn returns just to stay in place. But when you save in metals, you're opting out of that system. You're holding an asset that can't be debased by central bank policy. You're preserving purchasing power rather than watching it slowly leak away. Now, let's talk about what's happening right now in the supply and demand dynamics of precious metals. On the supply side, we're seeing constraints that haven't existed in years. Mining production has been relatively flat. It takes years to bring new mines online, and with environmental regulations and permitting challenges, it's getting harder and more expensive to extract metal from the ground. Meanwhile, demand is surging from multiple directions. Industrial demand for silver is at all-time highs. Silver is used in solar panels, electronics, medical applications, and increasingly in green energy technologies. As the world transitions to renewable energy, silver demand is projected to increase substantially. But here's the kicker. Silver is also money. It's also an investment asset. So you have industrial users competing with investors for a limited supply of metal. This creates a squeeze that we're already starting to see play out in the market. Gold demand is being driven by different factors, but the result is the same: more buyers than sellers at current prices. Central banks are accumulating. Wealthy individuals are diversifying out of financial assets. Countries are building strategic reserves. And retail investors, the everyday people who are starting to understand what's happening, they're buying coins and bars at rates that are straining the supply chain. Here's something that should concern you. The U.S. Mint has had to ration Silver Eagle production because they can't get enough silver blanks to meet demand. Premiums on physical metal, the amount you pay above the spot price, have been elevated for months. Delivery times have stretched out. These are signs of a physical market that's extremely tight. And when a market is this tight, it doesn't take much to trigger a significant price move. Let me tell you about the mechanics of a short squeeze, because I think we might be setting up for one in silver. In the futures market, there are large commercial banks that hold massive short positions in silver. They're essentially betting that the price will go down. But if the price starts rising and they need to cover those shorts by buying back contracts, that buying pressure can create a feedback loop. Prices rise, shorts get squeezed, they have to buy more to cover, prices rise further. We saw a glimpse of this a few years ago, and the conditions are even more favorable now. But let's bring this back to you and your situation. You've worked hard for your money. You've saved diligently. You've done everything you're supposed to do. But the rules of the game have changed. The financial system that your parents and grandparents operated in doesn't exist anymore. We're in uncharted territory with debt levels, money printing, and financial engineering that would have been unthinkable a generation ago. So the question becomes, how do you protect what you've built? How do you ensure that your savings maintain their purchasing power? How do you insulate yourself from the monetary experiments being conducted by central banks around the world? For an increasing number of people, the answer is physical precious metals. Now, I want to address something important. This isn't about going all in on metals and abandoning everything else. It's about balance and diversification. It's about having a portion of your wealth in assets that aren't dependent on the financial system functioning perfectly. Think of it as insurance. You don't buy homeowners insurance because you expect your house to burn down. You buy it because if something catastrophic happens, you're protected. Metals serve a similar function in your financial life. Quick aside here, If you're sitting on $100,000 or more in retirement accounts, there's actually a way to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA, and I put together a free guide that explains exactly how it works. It's in the description below. Covers the whole process, the rules, the benefits. Worth checking out if that's relevant to your situation. Anyway, back to what's happening in the markets. Let's talk about what happens in a real currency crisis, because I think it's important to understand the end game here. When people lose faith in a currency, they don't gradually shift their behavior. It happens suddenly. One day everything seems fine, and the next day there's a rush for the exits. We've seen this play out in countries around the world: Venezuela, Zimbabwe, Argentina, Weimar Germany. The pattern is always the same. The government prints money to solve its problems. People realize their currency is losing value. They try to convert it into real assets, and the currency collapses. Now, I'm not saying the dollar is going to collapse tomorrow. The dollar is still the world's reserve currency. It has advantages that other currencies don't have. But those advantages are eroding. And more importantly, even if the dollar doesn't collapse, even if it just continues to lose purchasing power at an accelerated rate, that's still devastating for savers. You don't need hyperinflation to destroy wealth. Steady inflation over time does the job just as effectively, it's just less visible. Here's what I find fascinating about human psychology and money. People have an incredibly hard time accepting that the money they've known their whole lives might not be as stable as they think. It's cognitive dissonance. The dollar has been the dominant currency for so long that it seems permanent, inevitable, unchangeable. But monetary systems change. They always have throughout history. The British pound was the world's reserve currency before the dollar. Before that, it was the Dutch guilder. Before that, other currencies. Nothing lasts forever. And here's the thing. The people who recognize these transitions early, who position themselves ahead of the shift, they're the ones who preserve and grow their wealth. The people who wait until everyone else figures it out, they're the ones who suffer. By the time the mainstream media is telling you to buy gold, by the time your neighbor is talking about silver, the big move has already happened. The smart money moves early and quietly. Let me share some specific numbers with you because I think they illustrate what's happening. In the past few years, we've seen gold move from around $1,800 to over $3,000. That's a substantial gain. But here's what's interesting. That move happened despite rising interest rates, despite a strong dollar index, despite conditions that traditionally would be negative for gold. Gold climbed anyway. Why? Because the underlying fundamentals, the debt, the money printing, the geopolitical instability, those factors overwhelmed the traditional headwinds. Silver's story is even more compelling. Silver has industrial uses that gold doesn't have. It's consumed in manufacturing processes, which means it's not just being hoarded, it's actually being used up. The above-ground stockpiles of silver have been declining for years. At the same time, investment demand has been increasing. You have this situation where industrial users need silver for production, investors want silver for wealth preservation, and there's not enough to go around at current prices. Something has to give. Now let's talk about the ratio between gold and silver, because this is important. Historically, silver has traded at a ratio to gold of somewhere between 15 to 1 and 60 to 1. Right now, we're at the higher end of that range. What that means is that silver is relatively cheap compared to gold. If that ratio reverts to historical norms, and there's good reason to think it will, silver has substantial upside potential. We're talking about the possibility of silver doubling or tripling even if gold just stays where it is. But here's what really keeps me up at night, and what should concern you too. The derivatives market in precious metals is enormous. There are paper claims on gold and silver that far exceed the physical metal available. It's a fractional reserve system, just like banking. And just like banking, it works fine until everyone wants their metal at the same time. When that happens, when the paper market breaks and people demand physical delivery, that's when you see prices go parabolic. We've already seen glimpses of this. There have been moments where the premium on physical metal spiked dramatically above the paper price, where you couldn't buy coins at any reasonable price, where dealers were out of stock. These are warning signs. They're telling you that the physical market is much tighter than the paper price suggests. And if we see a real crisis, if we see a genuine rush into physical metals, those premiums could explode. Think about what happened during the pandemic. Suddenly everyone wanted to buy gold and silver. Dealers were overwhelmed. Premiums went through the roof. Delivery times stretched to months. And that was just a taste of what could happen in a real monetary crisis. Imagine if people lost faith in the banking system. Imagine if there was a currency crisis. Imagine if geopolitical tensions escalated into something more serious. The demand for physical metals would be unlike anything we've seen. Here's another angle to consider. The younger generation, the millennials and Gen Z, they've grown up in a world of financial instability. They saw the 2008 crisis. They've lived through multiple recessions. They've watched housing become unaffordable. They've seen their parents' retirement accounts get decimated. They don't have the same faith in traditional financial institutions that previous generations had. And increasingly, they're looking at alternatives. Cryptocurrencies? Yes, but also precious metals. They understand that the system is rigged against savers, and they're looking for ways to opt out. This generational shift in attitudes toward money and savings is profound. It's creating a new wave of demand for hard assets. And unlike previous generations who might have been content to own paper gold through an ETF, this generation wants the real thing. They want to hold it. They want to control it. They don't trust intermediaries. This is creating sustained demand for physical metal that I think is going to persist for years. Let me tell you about something called Gresham's Law. It's an economic principle that says bad money drives out good money. What that means is that when you have two forms of money in circulation, people will hoard the good money and spend the bad money. They'll hold on to gold and silver, and they'll spend their depreciating paper currency. We're seeing this play out right now. People are accumulating metals and spending their dollars. They're recognizing which form of money is superior, and they're acting accordingly. Now, I want to address a common objection. People say, but gold doesn't pay interest. It doesn't generate cash flow. It just sits there. And that's true. Gold doesn't pay a dividend. But here's what it does do. It maintains purchasing power over time. It's not supposed to make you rich. It's supposed to keep you from getting poor. It's supposed to preserve what you've already earned. And in an environment where your savings account is paying less than the rate of inflation, where bonds are losing value in real terms, where stocks are at valuations that historically have preceded major corrections, preservation of capital becomes paramount. Think about it this way. If you have $100,000 in a savings account earning 1% interest, but inflation is running at 5%, you're losing 4% of your purchasing power every year. In real terms, you're getting poorer. But if you hold that $100,000 in gold, and gold appreciates at the rate of currency debasement, you've maintained your purchasing power. You haven't made money, but you haven't lost it either. And in the current environment, not losing money is actually a win. Here's something else to consider. Metals are no one else's liability. When you own a stock, you're relying on a company to perform. When you own a bond, you're relying on the issuer to pay you back. When you own dollars in a bank, you're relying on the bank to remain solvent and the government to maintain the currency's value. But when you own physical gold or silver, you're not relying on anyone. It's yours, free and clear. In a world of increasing counterparty risk, that's incredibly valuable. Let me paint you a scenario. Imagine we're 5 years in the future. The debt has continued to grow. The government has continued to spend beyond its means. The Federal Reserve has continued to expand the money supply. Inflation has remained elevated despite official claims that it's under control. In that environment, what do you think happens to the purchasing power of your dollars? What do you think happens to the price of hard assets like gold and silver? Now imagine the alternative scenario. You took action today. You converted a portion of your savings into physical metals. You diversified out of purely paper assets. You positioned yourself ahead of the crowd. 5 years from now, when everyone else is scrambling to protect their wealth, you're already protected. You made the move when metals were still relatively affordable, before the real rush began. Which scenario would you rather be in? Here's the reality. We're at a unique moment in financial history. The decisions you make now about how to store your wealth are going to have profound implications for your financial future. The old playbook, save in dollars, buy bonds, trust the system, that playbook was written for a different era. We're in a new era now, one that requires new strategies and new thinking. The people who understand this, who recognize that we're in the midst of a fundamental shift in the global monetary system, they're taking action. They're not waiting for permission. They're not waiting for the mainstream media to tell them it's okay. They're looking at the data. They're seeing what central banks are doing. They're watching the geopolitical landscape. And they're making informed decisions about how to protect their wealth. And here's the thing. This isn't about being a doomsayer or a pessimist. This is about being realistic. This is about understanding how monetary systems work and positioning yourself accordingly. The people who preserved their wealth through previous currency crises weren't lucky. They were prepared. They understood what was happening and they took appropriate action. You have that same opportunity right now. The metals market is still accessible. You can still buy gold and silver at prices that, in hindsight, might look incredibly cheap. The premiums haven't gone crazy yet. The supply chain, while tight, is still functioning. But that window won't stay open forever. When the crowd figures out what's happening, when the rush into physical metals really begins, it's going to be too late to position yourself advantageously. So here's what I want you to take away from this. The dollar is losing purchasing power. That's not opinion, that's mathematical fact. Central banks around the world are accumulating gold at record rates. That's not speculation, that's documented behavior. The supply and demand dynamics in precious metals are extremely favorable. That's not hype, that's market reality. And the people who recognize these facts and act on them are going to be in a much better position than those who don't. This is your moment to make a decision. You can continue saving in dollars and hope that the system maintains stability. Or you can diversify into hard assets that have preserved wealth for thousands of years. You can wait and see what happens. Or you can position yourself now while you still have time. The choice is yours, but the clock is ticking. The monetary system is changing whether you're ready for it or not. The question is, will you be prepared when that change accelerates? Will you have taken the steps necessary to protect what you've worked so hard to build? Because once everyone else figures it out, once the rush begins, it'll be too late to get ahead of it. The time to act is now, while you still can, while metals are still available, while you can still make this move on your terms. Don't wait until you're forced to act out of desperation. Make the decision now, from a position of strength, and secure your financial future before the window closes.